Let me talk about something that sounds fake, but unfortunately isn't. Most people fail at investing not because they choose bad products, but they fail because they don't give time enough respect. We love talking about which share is best, which ETF is cheapest, which platform is better, but almost nobody talks about the real engine behind wealth: time. I realize now I don't have a watch on. Not timing, not predictions, just time. People think they can plant a seed, come back 2 weeks later, and ask, why is there no forest? And that is the real problem and what we will be talking about today. Welcome back to the Investor Experience. If you are new here, we're busy with a mini series called Investing for Normal People. In episode 1, we spoke about what shares and ETFs actually are. And in episode 2, we spoke a little bit more about the mechanics between these two options. Today, we will be discussing how time influences your investment journey and what compounding interest is all about. But before we get there, if you haven't watched any of our other episodes, I would recommend you start there. Not because I want more views, which will be nice, but because it is very important that you first understand the basics before we can continue with today's session. So, let's talk about today's topic, which is all about compounding. But Roger, you said this channel is for normal people. Yes, I did say it's for normal people, but I did not come up with all these fancy investing words. The best I can do is try to break it down for you so it's more simple to understand. So, with that, I'm going to give you the easy to understand definition of what compounding is. Compounding is the recursive amplification of capital through the iterative reinvestment of accrued returns. Listen carefully, whereby the initial principle is and its subsequent yield into a self-referential growth mechanism that accelerates non-linearly over extended temporal horizon. In essence, value accumulation becomes massive as each marginal gain is submerged into the base upon which future gains are calculated, creating an exponential feedback loop whose magnitude is disproportionately realized in later periods, often misleading observers into underestimating its long-term impact during the early stages of implementation. Or, as we explain your investor experience, that compounding is when your money is start making more money and that growth accumulates. So to test if this definition actually makes sense, I've brought Riley here with me today. Riley, do you understand the definition of compounding? Give me a high five if you do. Nice. But border collies are quite smart. Maybe I should ask somebody else if they know what it means. Baby, do you know what
Yes, yeah, word that.
maybe let's get to an ad break. Hi everyone. I apologize for interrupting this episode today, but I wanted to inform you about a new sort of investor club community thing we are starting. I've included the link in the description below, and I invite you to go and check it out. Currently, we've got 2 packages on offer. The first one is the free one, which basically makes you form part of a type of mailing list. The next one is the one that I'm a bit more excited about. That is our paid subscription. Yes, you've got to pay, but it's quite cheap. And yeah, it gives you access to quite a lot of benefits. Things like downloadable content where we can get templates for various things you use in your life, such as budgeting and share tracking and stuff like that. And as we grow bigger, we're also going to include a lot more other benefits, such as insights into listed companies,
We're going to give free giveaways, make fantasy sport leagues, stuff like that. So yeah, go and check it out. And yeah, that's enough advertisements for now. Enjoy the rest of the episode. No, man, why are you recording? Show them the disclaimer.
The information shared by Wouter, aka myself, the Thai capital, and the investor experience is for educational and informational purposes only, and should not be considered as financial, tax, legal, or investment advice. I am not a registered financial advisor, and I'm not licensed with the Financial Sector Conduct Authority, or FSCA. The content on this channel, on our website, in courses, and across all platforms does not constitute financial advice or intermediary services as defined under the Financial Advisory and Intermediary Services Act. All information shared is general and intended to be educational in nature, based on publicly available information, financial principles, and personal experiences, and is intended to help you and improve your own financial literacy. Past performance is not indicative of future results, and all investments carry risks, including the potential of losing money, or even all of it. You remain fully responsible for your own financial decisions, and for any advice to your own specific situation, please consult with a qualified financial planner or advisor registered with the FSCA. Thank you.
Okay, I'm back. Sorry for that whole interruption and that scenario. I'm sure it will go better from here. So I guess the best I can do is delve a little bit deeper about the mechanics behind compounding and what it is all about so that everybody can understand, including Ilse. I love you, babe. So, compounding. Compounding is one of the most powerful forces in the investing world, but it's also one of the least impressive things in the beginning. And that is what the whole problem is. In early years, compounding looks like nothing is happening. Your money grows, but very politely, quietly, trying not to disturb anyone. Which is why most people quit. They say things like, this is not working, I could have done better elsewhere, and maybe they'll just sit and wait for a better opportunity. But compounding doesn't reward excitement. It rewards those who stay put. Compounding doesn't work in a straight line. It works on a curve. And curves, as you all know, is very unimpressive in the start and then gets very ridiculous at the end. And that's why most people never see the effects of compounding, because they step off this ride before it even started. As you all know me by now, I like explaining concepts by using simple examples. So, let's talk about compounding using an example and bringing in spaza shops as the thing that you would buy as your life's work. Step 1. You take all your money and you go and you buy your first spaza shop. You start selling knickknacks, some Coke, a mini bar one, a few fizzes, and you save every single cent. Because you want to grow and buy a second shop. Unfortunately, since you only have one shop generating profit, it takes 10 years before you buy shop 2. From a compounding perspective, your growth is very slow since you only have one shop working for you. Now we get to shop 2, and you can start to see how compounding takes shape. You now have 2 shops generating income. And because of this, it only takes you 5 years to buy shop 3, not 10 as when you only had one shop. Why? Because 2 shops are earning income, not one. You can start to see how compounding is working its magic. Suddenly, you have 3 income producing units. If we assume the same pattern continues, and that your income roughly scales with the number of shops, the time to buy your next shop keeps on shrinking. You can see when your curve starts taking shape. So instead of 5 years again, it might only take 3 or 4 years to buy shop 4. Not because anything has changed, but because your shops, aka investments, are now working at the same time. Your babies is giving you more money. By the time you get to shop 10, you can almost open a new shop in less than a year. Nothing magical happened, well, except compounding. You didn't suddenly work harder. You didn't suddenly get smarter. You just let the existing shops fund the new ones. And that is how it links back to our original definition, the simple one. Compounding is when your shop starts buying new shops faster than you can ever do on your own. Because your shop babies is now also working for you. By now, you're probably asking, but why do people miss this? The reason is the first 10 years feels very slow. It takes longer to get from shop 1 to 2 than it would take to get from shop 10 to shop 20. The progress in the beginning is disappointingly slow early on. And to be honest, most people quit before they even get to the second shop. But once you reach that point where your one shop starts funding your second shop, or the returns of your first investment starts funding new investments, time starts shrinking. And that compounding that felt invisible at first starts feeling unfair later on. And markets work the same way. For years, it feels like nothing is happening. And then suddenly, everybody wants in. And the people who benefit aren't the ones who arrive late. They're the ones who stay and started investing early on and kept being patient. And that is why most people don't lose money when the market collapses. They lose money because they can't leave things the hell alone. They focus, they start to panic and start selling everything. They maybe just want to quickly tweak the plan a little bit. And that's sort of like investing way of digging up a seed that you just planted to see if it's growing. Just leave it alone. Give compounding time to work. And then why does this matter to me? What does this mean for you? It means that starting early matters more than optimizing. Consistency beats intensity. It means that the best strategy is just starting and sticking with one that you can actually stick with. When life gets busy, markets get noisy or going down, when motivation maybe disappears a little bit, whether it's actually investing in shares or ETFs or both, it only works if you invest and you stay put and be patient. Therefore, let me end this episode by leaving you with a small Chinese proverb. It goes like this: 金公公瓜, which translates to wealth isn't built by prediction, it's built by patience. Remember, your spaza shop empire doesn't grow overnight. If you give it enough time, one day you look up, or maybe down at your spaza shops or left to the spaza shop, wherever, you look and you realize that you've been standing on something that you never thought you would build. Thank you for watching this episode. Please remember to subscribe and like and comment and help grow this channel a little bit. As I always say, one small step for you is one big step for the investor experience. In the next episode, we'll be talking a little bit more about how much money you actually need to get started. So make sure you don't miss it. Cheers. Pwede may Vienna. Try this.